Disinflation is different from deflation. Deflation is when prices actually drop. Disinflation is when the rate of increase in prices slows down. And that is where we are now. We had in 2022 double-digit inflation in the United States. And now we're down to 2, 3, 4%, depending on which measure you look at. So inflation, in other words, the rate of decline in the value of the dollar is slowing. But, it's never really been zero, or hardly ever been zero since 1970 when we went to a fiat currency. And there's no way that it will be for long periods of time zero ever again. We can't in the current system get to stable prices because we've taken on so much debt that the only way for the world's governments to manage that debt is to create a whole bunch of new currency and dump it out into the market. That limits their interest expense on their debt, but that also makes the dollar lose value and makes all the stuff that you and I buy day to day go up. So we're in a place where that cannot be changed. We're going to have inflation going forward. And the only question is, when does that become so disorderly that it breaks the system and we have to just sit down with a blank sheet of paper and create a new monetary system, which sounds crazier than it actually is. We've had monetary resets multiple times, the last time being the 1950s. So it won't be like digging in rubble to try and find some ideas, because we already have the ideas for how to do it out there. And it'll be a question of choosing. Do we want to go back to a gold standard? Do we want to bring Bitcoin into the mix? Do we want to do some kind of a law that just forbids governments from borrowing anymore and control the money supply in that way? That'll be the debate. But, I suspect we're close now. That's the kind of thing that might dominate the headlines in a year or two. First of all, the Fed funds rate is an interest rate on overnight deposits in the banking system that the Federal Reserve controls. It gets to set that interest rate. And the lower the interest rate is, the cheaper money is, and the more likely people are to borrow, and the faster the economy grows. That's the relationship between that rate and the economy. But if you look to the left on that chart, you see interest rates were once way higher than today. So somebody looking at that chart would say, we're not in the danger zone. We've had much higher interest rates than this in the past, and we were okay, right? And the answer to that is, yeah, we were okay back then, but we won't be okay this time around, because back then, in the 1970s and 1980s, we were actually in pretty good shape financially. We didn't have that much debt. And because of that, we were able to use really high interest rates to manage the currency crisis that we had in the 1970s. So mortgage rates went to like 16 to 18% back then, and the economy didn't collapse. Now, the reason why we can never do that again is because in the ensuing few decades, we borrowed insane amounts of money at every level of every major country. And so for interest rates to go up even a little bit from here risks bankrupting governments, corporations, individuals all over the world. If the US now has, well, let's say, to keep round numbers, where we're approaching $40 trillion in debt. And if the average interest rate on that goes to 5%, you're talking $1.5 trillion, $2 trillion a year just in interest. And Japan has the same problem. Most of Europe has the same problem. So we cannot raise interest rates from here. And the question is, are we going to leave them where they are, or are we going to cut? That's the debate going on in Washington right now. We probably are headed for a recession. There's an awful lot of indicators. When we talk about housing today, your listeners will see just how brutal the housing market is becoming right now. And then there's commercial real estate and everything. And then student loans are kicking back in. Credit card debt is soaring, and credit card defaults are also soaring. So you got a lot of people putting day-to-day life on credit cards right now and not being able to cover the 25% interest, or not being able to pay their student loans after having 3 or 4 years without having to pay them. A lot of that out there that all point towards lower consumer spending in the year ahead, because we're 70% consumer spending driven as an economy. That produces a recession. And now, meanwhile, the Fed did start cutting interest rates last September, but they only got to cut the Federal Reserve rate. Everything else, all the other interest rates went up. So the 10-year Treasury note yield, which is a very big benchmark yield, went up dramatically after the Fed started cutting interest rates, which means they're not listening to the government anymore about interest rates. And that pulled mortgage rates up. So we're back to like 7% for a typical 30-year fixed rate mortgage, which, with house prices being what they are, it basically prices everybody out of the house market. If you have to buy an overvalued house, which with extremely expensive money, your monthly cost is crazy high. Most people can't handle it. So anyhow, so we get a recession. the central banks of the world, not just the US, but all the central banks will then have to cut interest rates aggressively. And if long-term rates won't go down, they will have to go in the market and buy long-term bonds in order to force long-term rates down. And to get the money to do that, they have to just create new dollars and euros and yen out of thin air. So we get a recession followed by aggressive monetary easing, followed by financial instability, because that's going to push down the price of the world's big currencies, which is to say inflation goes up, and there's our death spiral, financial breakdown, monetary reset. So I think it could happen as part of this cycle because we've taken on so much debt. If you look at how much debt even just the US took on in the past 10 years, we came pretty close to doubling our debt in one 10-year cycle, and that's took us 220 years to get to where we were in 2011. And then by the early 20s, we had taken on that much debt again. And you can't do that for very long without blowing up the system. And I would argue that we're close to that point right now. We are looking at a classic housing bust right now because the way it typically works in very general terms is home prices go up, and they get to the point where they're unaffordable. The average person can't buy the average house. And then sales really slow down because you can put your house on the market at current prices, but nobody can buy it. So it just sits there. And then sellers start to get worried. And so they cut their prices a little bit. And that affects comps. In other words, houses become less valuable across the board once a few sales at a discount happen. And that spooks everybody else who's kind of on the fence. Maybe they could sell, maybe they don't feel like selling, they start to dump their properties on the market until you get this huge imbalance. Lots more houses for sale than there are buyers out there. And if you're going to sell a house in that kind of a market, you got to be seriously motivated. You have to cut your prices dramatically. And then you get this waterfall decline where sales pick back up, but it's because people are cutting their prices so dramatically. And you see prices drop. In the last bust, which was a very big one, admittedly, but there were 30, 40, 50% price drops in a lot of markets. And when you think about that for a house, which is a leveraged asset, say you put down 20% and you buy a house and it drops by 20% and you lost your whole cash investment. The money you put into that house is gone because you only put 20% in. So that causes basically chaos in the housing market when people are just, okay, just get me out at whatever, I don't care, and then you get the kind of waterfall decline in home prices and a spike in deals as people start coming in, vulture investors and people, looking to get a good deal, and they have an understanding of what the actual real value of a house is. So they're willing to take some of these offers. That starts happening. And then, the housing market eventually flattens out at much lower prices, and then normality can return. But in the meantime, you have a recession because housing is such a big part of the overall economy that when you have a housing bust, it's really hard to have a growing economy. And in our case right now, housing, even though it's pretty much a classic bust, emerging right now where prices are going to go down, people are going to take some really big losses, and it's going to make them feel dumb and poor, and they're not going to spend as much money. That's just one thing that's happening. You got commercial real estate that is at least sections of it that are going bust, and you got people, as I said before, people with credit card debt and student loan debt, and you've just got a ton of different sectors out there that are all in some kind of trouble. And housing might follow that, or it might lead the way. There's no way to know what happens in the next 6 months, or you could have them all fall at once. And, there's no way to know except that it almost doesn't matter unless you are in one of those specific markets. But if you're somebody who's trying to decide whether to short the stock market or whether to buy gold and silver or whether to buy a starter house, even though you can afford a bigger house, if you're just not directly connected to these things that are going bust, then it's not that big of a deal for you. You can sit back and watch it all happen. But if you're in the middle of something like this where your job depends on home builders or something like that, then you have a really serious problem. And there's an awful lot of people who are in that kind of a situation because you can't go bankrupt and get rid of your student debt in that way. You have to keep paying it off no matter what. So if that is the case for a lot of people, then they have to rein in their spending. And then all the people who are benefiting from that part of the consumer spending complex, they lose their jobs. So that's kind of what we're looking at. It's in some ways a typical recession, and in other ways a much more dangerous animal because we have so much debt. So we could have a recession and an equities bear market, and instead of everything bottoming and us going back to normal, it could just metastasize. It could just roll us over into a 1930s style depression. And And that's the thing the governments are terrified of. And that's why we get super low interest rates as soon as there's a hint of a recession right now, because they know it could happen and they want to lean against it immediately. Currency crisis is bad for lots of people, especially the people who trusted the government. So if you got your kids' college fund in bonds and tech stocks and cash or something like that, and then we have this bout of inflation that makes bonds and cash worth only half of what they were when you put them in there, then yeah, that's very tough. And that's what's staring a lot of people in the face. And, it's hard to know what to do about that. However, there's another category of people, that basically the gold bugs and the preppers, who have seen this for a long time coming and have been what they call stacking, where you just buy a few more silver coins until your stack gets really big. And this has been kind of a brutal 10 years for those guys. And I include myself in that group. And we have been, buying our gold and silver while gold bounced off 2000 and back down for a really long time, and silver didn't go up at all. Meanwhile, tech stocks were going through the roof, and Bitcoin is $100,000, and house prices are through the roof. And so we suffered by being too early with all of this, but now it's paying off. Now gold is just rocking. Gold over the last 3 years has outperformed stocks and bonds. So it's the best performing big asset out there now. And silver is starting to outperform gold. So, the people that were too early into precious metals, but have now accumulated quite a bit of it, are among the best performing investors in the world right now. And the reason that gold and silver looked so good back in the day is that we were clearly blowing up the fiat currencies. The dollar was clearly going to be inflated away. And historically, going back 3,000 years, when a government does a stupid thing like that, gold and silver turn out to be the places where you make money, or you at least protect your capital. So assuming 3,000 years of history wasn't going to be debunked or discredited in the next few years, gold and silver were the place to be. And they have turned out to be that way just lately. We'll see where we go from here, but I think previous precious metals bull markets have a pattern. And if this bull market in gold and silver follows the same pattern, they go through the roof from here. I'll go out on a limb and say $100 silver. It's $30-some an ounce right now, but $100 silver is very easy to envision if the past is prologue in precious metals.